Why are banks failing in the United States? The banking system in the United States has long been considered one of the most robust and resilient in the world. However, recent high-profile bank failures and financial instability have raised questions about the sector's health. From economic shifts to regulatory weaknesses, the causes of these failures are multifaceted. In this article, we'll explore the key reasons behind the challenges facing U.S. banks and their broader implications for the economy, rising interest rates, and their ripple effects. One of the most significant factors contributing to recent bank failures is the rapid rise in interest rates. The Federal Reserve's aggressive rate hikes aimed at combating inflation have had unintended consequences for banks. Impact on bond portfolios. Many banks hold large amounts of government bonds and other fixed-income securities. Rising interest rates lower the market value of these bonds, creating unrealized losses that can erode a bank's financial stability. Cost of borrowing. Higher interest rates increase the cost of borrowing for businesses and consumers, leading to reduced loan demand and lower revenue for banks. Liquidity crunch. As customers seek higher returns elsewhere, banks face deposit outflows, straining their liquidity and forcing them to sell assets at a loss. Mismanagement and risk-taking. Bank failures often stem from poor management decisions and excessive risk-taking. The pursuit of higher profits can sometimes lead banks to overextend themselves in risky areas. Overexposure to specific sectors. Some banks concentrate their lending or investments in volatile industries like tech, real estate, or energy. When these sectors face downturns, the banks are disproportionately affected. Failure to hedge risks. Banks that do not adequately hedge against interest rate or credit risks leave themselves vulnerable to sudden market shifts. Lax governance. Weak oversight by boards of directors and ineffective risk management practices can exacerbate financial problems. Weak regulatory oversight. Despite significant reforms after the 2008 financial crisis, gaps in regulatory oversight still exist. These weaknesses contribute to the inability to prevent or mitigate bank failures. 1. Deregulation. Changes in regulatory frameworks, such as the rollback of certain provisions in the Dodd-Frank Act, have allowed smaller and mid-sized banks to operate with less scrutiny. 2. Stress testing. While large banks undergo regular stress tests, smaller institutions often face less stringent requirements, leaving them more vulnerable to economic shocks. 3. Inadequate supervision. Regulatory agencies sometimes fail to identify or address warning signs early enough, leading to crises that could have been mitigated. Technological disruptions. The rise of fintech and digital banking has disrupted traditional banking models, creating both opportunities and challenges. Competition. Fintech companies often offer more competitive rates and innovative services, attracting customers away from traditional banks. Cybersecurity risks. The growing reliance on digital infrastructure increases banks' vulnerability to cyberattacks, which can erode customer trust and financial stability. Digital runs on banks. In the digital age, customers can withdraw funds with a few clicks, making bank runs faster and more severe than ever before. Broader economic pressures. The overall economic environment also plays a significant role in the health of the banking sector. Inflation and recession risks. High inflation and the potential for economic slowdowns put pressure on both borrowers and lenders, increasing default risks. Geopolitical uncertainty. Global events, such as conflicts or supply chain disruptions, can impact financial markets and create volatility. Consumer confidence. Public perception of a bank's stability is crucial. Even rumors of financial instability can trigger a bank run, compounding existing issues. Implications for the future. The failure of banks has far-reaching consequences for the economy and society. It undermines public confidence in the financial system, disrupts credit availability, and can lead to job losses. While federal agencies like the FDIC often step in to protect depositors, the broader effects on businesses and consumers can be severe. To prevent future failures, several measures should be considered. Enhanced regulation, strengthening oversight and stress testing for banks of all sizes. Improved risk management. Encouraging banks to diversify their portfolios and adopt better risk hedging strategies. Technological adaptation, investing in cybersecurity and embracing digital innovation to stay competitive. The failure of banks in the United States is not the result of a single factor, but rather a combination of economic, managerial, regulatory, and technological challenges. While the system is far from collapsing, these issues highlight the need for vigilance, adaptation, and reform. By addressing these vulnerabilities, the U.S. can maintain the resilience of its banking sector and safeguard its economy in an increasingly complex and uncertain world.